Hi everybody, my name is Griffin Bridgers. This will be part 6A, a supplemental part of the basics of generation skipping transfer tax. And what I'm going to aim to do in the supplemental part, for reasons I'll explain in a minute, is re-explain what I brought up in part 6, which is indirect skips. Before I get into the egg on my face part, I want to remind you that this presentation is not intended to substitute for legal or tax advice and is provided for educational purposes only. So, in part 6, I introduced the concept of indirect skips and of GST potential, and really I did so in the context loosely of trusts and the gift tax return Form 709. And I think because I emphasized the definition on Form 709 so much, I failed to see the forest for the trees in the way I went about presenting the topic of indirect skips. But with this entire series, my goal is simplification, and I want to apologize to you because listening back to the discussion in part 6, I don't feel like I was as clear as I could have been. So instead of replacing part 6, because there still is valuable information there to aid your understanding, I found it better maybe to do this supplemental part 6A and give this discussion to tee up some topics that I had kind of glossed over as well, taxable distributions and taxable terminations, so that going into the gift tax reporting, we have a little bit better lay of the land. So I'm going to redefine indirect skip, not based on the code, not based on the gift tax return definition. I'm going to simplify it. Before I simplify it, I have to look at a negative. We've learned about skip persons, and this is going to be a highly complex definition, I know, but anyone who's not a skip person is known as, drumroll please, a non-skip person. Highly technical, I know, but anytime we have both skip persons and non-skip persons involved in a transfer, that is going to be the classic example and a better definition, I think, of an indirect skip. So to restate that, an indirect skip will be any sort of transfer where immediately after the transfer is completed, both skip persons and non-skip persons have an interest. And typically this will be a transfer where there's a gift tax reporting obligation or an estate tax reporting obligation that accompanies it. So, same thing I talked about in part 6. When you have a sale to a trust, assuming it's for full fair market value, you don't have to worry about this definition. It's only going to be when there's a gift to a trust that we're really worried about this definition of indirect skip. So in other words, if there's a gift to a trust and immediately after that gift, both skip persons and non-skip persons have an interest, then we will have an indirect skip. So to give you an example of this and how it fits into the allocation scheme and this other loose definition, GST potential, that I let kind of hover in the background, we're going to create this fact pattern. We're going to assume there's a grantor of a trust who's a parent, and they set up that trust for their living children and for their future descendants as well. At the time that this trust is set up, no grandchildren of the grantor are living yet. But the term descendants is used to define the beneficiaries of the trust, and that includes, under state law and the trust itself, any future born descendants of the grantor. Now recall that descendants that are 2 or more generations younger than the grantor can be skip persons. So what this means is that there's no skip persons alive yet, but each time a grandchild or even younger beneficiary is born, maybe a great-grandchild, they instantly become both a beneficiary of the trust and a skip person. And that's what's known as GST potential. So in this trust, there's this possibility that in the future property could pass to a skip person. Now at the time, there could be no living grantor then still alive. So the question is going to be, who pays the tax in that sort of situation? Well, that tax is going to relate back to events happening when this trust is created. And that event that's really going to drive this is the allocation of GST exemption. What we're going to find out is that in this trust, the tax code automatically allocates GST exemption dollar for dollar to the extent the grantor has any left. And if the grantor doesn't have any left, the GST exemption might be allocated to part of the trust, the consequence of which we'll look at in a later discussion. And instead, as we introduced back in Part 5, the grantor could instead elect out of that automatic allocation and choose to either manually allocate GST exemption in part or in full, or not at all. So that's a better example, I think, of an indirect skip. But to really further this definition and the context behind it, we're going to look at a problem and the solution when it comes to indirect skips. I kind of teed that up showing the timing issue here, because no skip persons are living at the time that the trust is created. So there's none living, and even if they were living, we'd have no idea how much might ultimately go to a skip person until some distant point in the future, where either there's property distributed from the trust to a skip person who's then living, or a situation where all the children, i.e. the members of Generation 2, die out or lose their interests in the trust. And at that point, the only remaining beneficiaries would be in Generation 3 or below, and would, in other words, the only remaining beneficiaries at that point would be skip persons. So this kind of tees up what we're going to look at later. Each of those sub-bullet points is essentially the definition of a taxable distribution and a taxable termination. But I want to give that its own separate part where we'll revisit those definitions later on. Now, between now, when the trust is funded, and then when there's this distribution or termination of the trust could potentially grow, even astronomically, to a point where there could be a lot of GST tax at some point in the future. So the problem is, how do we avoid GST tax at these distant points in the future that could happen well after the time that the grantor is living? So that's where the GST exemption allocation and the mechanisms relating to that kick in. This is our solution, because although there might not be any GST transfer until some point well in the future, I want you to hearken back to the point where I mentioned in a prior part that allocation of GST exemption affects the GST tax rate. There will be another part later on where we dive into that a little bit more again, but on this point, we need to contrast that with the gift and estate tax applicable exclusion, which is the same as the GST exemption, but the gift and estate tax applicable exclusion works differently. It doesn't affect the tax rate. Instead, it reduces the tentative gift or estate tax on cumulative transfers as an applicable credit against tax. So what's the difference between those two? Well, the difference, as I mentioned, is timing. That's our theme here. The gift and estate tax is usually payable immediately when there's a transfer and not at some point in the future, unlike GST tax in the event of an indirect skip, as we're seeing here. So what happens, and what we're going to continue to drive home, but I'm introducing this point now, is that the solution is that if you allocate GST exemption dollar for dollar to an indirect skip transfer at the time that that transfer by gift happens, what it does is it locks in, through a mechanism we'll later discuss, a 0% GST tax rate. And that GST 0% tax rate will continue to apply now and in the future for perpetuity, so long as the trust stays intact and the transferor of the trust does not change. So what that means is that all that future growth in the trust, even though it might be subject to GST tax, is only subject to GST tax at a 0% rate. And this outcome, what I just described, is what we'll come to find out and define as a GST exempt trust. And we'll dive in even more and look at how some types of trusts that were created before a certain point in time in 1985 may be grandfathered in and may naturally be GST exempt because they existed before the GST tax in its current iteration was enacted. So what's coming? Well, I'm going to layer in another sub-bullet point that, I guess, in the natural order of things should precede the other things I introduced in part 6 to tee up, and that'll be taxable distributions and terminations, because we now have the context to discuss those based on this clarifying supplemental part 6a. Then we'll move on into the specifics of GST exemption allocations on Form 709, definitions of GST trusts, which could be an exception to automatic allocation, and the definition of estate tax inclusion period, or ETIP, which is an exception to both automatic and manual allocation, and then finally the GST tax annual exclusion and how it shoehorns in with the gift tax annual exclusion and some of the differences where it can't necessarily apply the same, especially for traditional crummy powers. So far, we've covered these terms, and we're really adding a couple or supplementing a couple, and that's GST potential and indirect skip. So you can add those to your arsenal of terms that we've covered so far. But if you've listened this far, I want to thank you for your patience in listening on in this Basics of GST Tax series. I hope this helped to clarify things for you a little bit more. As always, if you have questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com with the caveat that I cannot give tax or legal advice in response to your questions. But I thank you again for listening to this series, and I look forward to seeing you in my future content.